It's great to be on this call. Great to have this fantastic company on this webinar. My name is Amir Amelzadeh. I'm an associate professor of accounting at Said Business School and the co-director, I should say, with Kern Alexander, who's also on this call, of the bank governance program, um, our executive education program around banking issues, and of some of which we will discuss essentially today. Um, Before we start, I'll quickly introduce our panelists as well in a second, who are essentially our former or alumni of the bank governance program. All of them vast experience in on bank boards, in banking, and in various areas of banking. So we're very happy to have you all here to share some of your experience on some of the urgent questions and some very interesting questions. Also, given the date today, I'd say of what we're expecting in the US, so we can talk about all the uncertainty that banks have to deal with, and a couple of other projects. Before I start, let me quickly share one or two slides so you know who you're talking to, and then we can kick off. Let me just get that sorted. There we go. And just a second. Gives people some more time to join, which is good. Here we go. Oh, okay, I assume you can see my slides. Okay, great. So what we want to talk today about is essentially building resilience in banking. And I think it's a quite important topic given the circumstances that banks face themselves in, and there's various dimensions of changes that are that you have to deal with, from the political side, economic uncertainty, to essentially technological change and regulation, of course, which has always been there. So before we start, I want to introduce, I've already introduced myself. Kern Alexander is my co-conspirator on the Oxford Bank Governance Program. He's a co-director of the program and professor of law and banking at the University of Zurich. Formerly, both of us have been at Cambridge as well. And then we have Sarah as well, who joined us, who's our senior consultant on the program, who's the point of contact for everyone on this call if you want to know more about the program and how you can sign up. And I hope I'll see many of you and later on in June as well. Please contact Sarah, and I'll hand over to her later as well. But more importantly, I want to talk to you about our guest speakers here on this call. We have Imtiaz Khan here with us, who has a long career and a long oh, no, I swapped my slides. There we go. A long career in banking, and is now in private equity, focused on essentially growth markets and growth companies in East Africa, essentially looking at equity investments along a variety of spectrums. He has experience at Cassia Capital Partners. He was at Standard Chartered, at the IFC, at PwC, and really focuses on financial services in emerging markets. So brings in that emerging markets view, which will be very interesting. So Imtiaz, it's great to have you on this call. We have Isaias Lima with us as well. He's managing director at Bancorp, and is a long-standing executive in compliance and in risk management, in particular with experience in risk management and regulatory compliance within the banking sector. Isaias specializes on anti-money laundering and financial crime prevention, and has led various KYC and transaction monitoring initiatives, particularly in the consumer and commercial and credit card business and banking. So Isaias, welcome. It's great to have you. And last but not least, Juliet Anama, who is the Chief Executive Officer at CGNR Strategy. And Juliet has also many years I think 18 or more years of experience in banking, in particular on consumer behavior and strategic planning. Lots of experience on model design and building collaborative partnerships in banking. She's developed numerous and implemented numerous strategies and roadmaps, and essentially also has worked on driving sustainability and ESG initiatives in advising senior leaders on these. So Juliet, it's great to have you on this call as well to share your experience. So I want to just dive right into the topics that we want to cover, and there's quite a wide range. We're talking about banking resilience, but we thought we'll talk a little bit about political uncertainty, which has become important, the changing regulatory landscape, and Ali Kern has vast experience on the regulatory side and can talk a little bit more about that. And then we'll cover a bit on technology, AI, and competition from fintech, which is, of course, given the developments at the moment, another very important aspect that bank board leaders have to deal with and think about how to position banks. And then we open up for Q&A from the audience, and I'll hand over for the wrap up to Sarah as well. Before I start with some questions to the panelists and then opening up to Q&A, let me just show you this. I prepared one slide. This is the one slide that I wanted to show you. So this essentially shows you in economic policy index, uncertainty index, which is the one in blue, and a geopolitical risk index, which is the one in red, all normalized so that they're on the same scale from essentially the 1997. And I think and this is why I'm showing this, what I find quite interesting and stark is the significant rise. So if you think about the last like 3 decades now, a significant rise in policy uncertainty, and essentially now also starting geopolitical uncertainty. And you can see in the 2000s is 9/11, and then obviously Iraq war, the Iraq wars. But you can see we are getting essentially very heightened levels of uncertainty. And then the question, of course, begs the question: how do you deal with this as bank directors, as bank executives, particularly leading international banks? So I want to start with that question, and I'll stop sharing with that question to the audience, and maybe I'll start with Imtiaz first. How you think bank boards and in particular the financial services companies that you're looking for and investing in, how boards and executive teams should adjust their strategies. Should they adjust their strategies to deal with this kind of political uncertainty, or is it just a daily business and we can go on as we have done before?
Thank you, Amir. It's an honor to be here and a real pleasure. And we are indeed in very uncertain times from a policy perspective and from a geopolitical risk perspective. Can you hear me clearly?
Yeah.
Absolutely. Yeah. So times like this, the boards really need to lean in. There is a temptation when uncertainty goes up for boards to take a step back and wait to see where things land. And what I've seen is actually it's quite the opposite that is required, and it's quite the opposite that is happening. And what the boards are doing is taking ownership of the big problem and the uncertainties that are swirling around, engaging with the executive management team much more robustly, asking the team to plot out what the scenarios look like, engaging with stakeholders, even more important. We've got various stakeholders, and so that communication is becoming key, and getting transparency right down the organizations, percolating clarity around what is our mission and purpose. And the biggest things boards do in times like this is to project steadiness, to project confidence and optimism, which is very difficult to do in these uncertain times. And the way to do this is if you have open communication channels all the way from stakeholders, executive management teams, down to the staff, but also with the regulators. And so what I'm seeing boards doing overall is leaning into the problem rather than stepping back and waiting to see where things land. It's a tricky balance, because what you do not want to do is to be seen to be micromanaging the executive management team. And you want to balance stakeholder expectations, regulator expectations, and having clarity together with the executive management team member. That's what I'm seeing. And that's the big theme around how to navigate in these very uncertain times.
Oh, very interesting. And you mentioned right at the beginning, scenario plans, or going through scenarios, and maybe even stress testing some of those scenarios of what might happen in this with this uncertainty, because I think that's one big tool that is quite useful in dealing with uncertainty and going through different potential scenarios, what might happen, because we don't know, right? That's the whole nature of uncertainty. But Isaias, maybe from kind of a risk management compliance perspective, um, should boards then get more frequent updates from risk managers? Should they engage more with the risk managers, given essentially the uncertainty, that how to deal with uncertainty? Because risk managers traditionally are used to this, right?
I agree 100%, and I also echo what Imitiaz said about stakeholder involvement, board involvement, scenario planning, and preparation. But I think another very important component is adaptability, because with political uncertainty, there is policy uncertainty as well. So from a regulatory standpoint, what we have seen, especially in the United States, is that regulation comes, what I would say, in cycles. When it is a democratic government, regulations tend to be more strict. And then in a Republican government, regulations tend to be more lax, or a tendency to deregulate. So I think the decisions banks and boards have in their hands is how far should we go? Understanding that this is just a cycle. Maybe over the next 4 years, policy will change again, and then we'll have to make adjustments. So I think adaptability, being in a position to be sufficiently informing a board that a balanced approach may be the best way to go, is a mechanism where we can stay ahead and try to cope with all the uncertainties that we see around us.
Thank you. No, I agree. And Julia, to bring you in with that, so staying on top of these issues and obviously bringing in the board, what do you suggest non-executive directors do, and what's their role in all this?
Yeah, thanks. Really super happy to be here. And Amer, maybe I should just first start with clarifying about my background. It's more fintech than actually banking. And of course, I serve on the board of a wholesale bank, a development bank of Nigeria. Yeah. I mean, great conversations. And I think there's a lot that non-executives who serve on bank boards can bring to bear. I think one of the critical things that comes to the fore with everything that's happening right now in terms of geopolitical issues is that we realize that geopolitical risks and policies, they actually don't come suddenly. It's like we tend to manage them as if they arrive suddenly, right? But when banks look at the history, they find that over time, these policies have been developing. Before they become rules, before they become law, before they come to the fore, they have been developing in the background, right? And what tends to happen is that most organizations, and banks included, don't tend to manage what I call their non-market environment strategically. we tend to manage very well a market environment. We have financial operations, we have credit and marketing, we have investment. Those are all market-facing functions, but very little attention to functions that actually look at your non-market environment in a strategic manner that looks at all the kinds of social actors that can apply pressure on a banking institution, whether that pressure is formal in terms of rules and regulations, or it is informal in terms of just pressures from activist groups and all that. So that's a more strategic way of looking. And if you do manage it strategically, you will see some of these things coming down the road, because there is a cycle and a pipeline for every single policy that finally hits you, unless it was driven by a disaster like COVID-19 or something like that. It was incubated, then developed before it matured. And that's what we need to pick up. That's what we need to be able to pick up when it's at that incubation stage. And we know, follow it all through, so we're able to shape it. That's what our non-market teams, whether it is your global policy teams or whatever, that's what they should be doing. So we're shaping it before it matures into something that then becomes a problem. I mean, post that it's some of the things you talked about earlier. And now we have a risk oversight committees that are, then looking at, risks that are coming in the horizon. But I think it's that strategic management of a non-market environment. That's the other thing that I would say that, we need to, as banks, start to incorporate into our overall strategies. And these are things that non-execs can raise and say, hey, this is something we should be doing if we're not already doing that.
Thank you, Julia.
I was just going to ask a follow-up in that area. Julia, of course, works with a fintech startup, and in the fintech area, we've seen in the U.S. at least this week, the issue of digital assets is in the headlines with Circle Internet, one of the stablecoin companies. They announced they're going to do an initial public offering, and one of the reasons that's been given for this has been that the U.S. authorities will relax the regulatory controls around the issuance of crypto assets. So I was wondering, in the crypto asset space, do we see in this kind of course, this is a market itself, but the non-market aspects that affect the development of the crypto asset markets, do you see that as in an incubation period now? Is it changing? Is that something that bank boards should be talking about?
In my view, if I may take that, Amer, I think it's something that a bank board definitely should be looking at. In fact, when you talk about all the potential risks, out of the known risks that banks typically look at, we look at Basel III and IV, we look at regulatory oversight, we look at climate change and so on. This is one big bucket that banks need to be looking at. And we should have been looking at it from early stages of when it was incubating up until now, when we now have these kinds of issues arising. Definitely. So my answer to that is yes, definitely. Thank you.
And just to pick up on that, and to what you just mentioned before as well, in having the risk committee obviously informing the board. So that kind of gets me to the question of what kind of governance mechanism, if you think about it, like what kind of governance mechanisms should be in place in a bank to deal with these new regulations, or relaxing of regulations, and hence new ways of business, or with the policy uncertainty. So are there any mechanisms that are crucial for a bank to prepare itself for kind of whatever it is, trade policy, new trade policies, tariffs, uncertainty? Isaias, do you want to, you're nodding, so you like.
Yeah, I think I see that banks need to be prepared, not only having established risk committee, but actually crisis management team at this point, right? There is a lot of changes happening in the marketplace, and we need to be prepared. In terms of the crypto assets, for example, my comment in there is that innovation always supersede the pace of regulation. And for banks to get engaged and involved in those spaces, there needs to be clear guidance from the regulators, right? So my bank, for example, we refrain from doing business with cryptocurrency because the reality is, from a BSA/AML standpoint, is a high-risk product type, and we try to not get heavily engaged. But the regulators are incentivizing because of the new administration and, and what they are doing when it comes to crypto, but it's not something we do. But going back to the prior point about what banks can do, again, crisis management, the scenario planning situation that was mentioned in here before, that can prepare, but it's not a guarantee that whatever measures you take will be well received by your regulators. So again, you're in between balancing of two different equities in here that is very, very difficult to balance because regulators have a very different view than the market has.
I mean, if I may build on what Azaz just said there, is one of the ways, one of the mechanisms, I suppose, is you need to assess, you need to, as the board, you need to challenge the executive management team to assess where your boundaries are, what risk appetite you have in different areas of business. And this falls squarely on the risk management committee, but it's a challenge to see how far are we willing to push the boundaries in terms of the risk appetite we're willing to take. And if you have clarity on that, then you have a better defense mechanism around the turbulence that you're going to encounter.
Thank you. So the really well-defined risk appetite and parameters of where the bank wants to operate, and as Isaiah said, things that you do and that you don't want to essentially engage in given the risk, right? So that kind of falls into exactly that place. That's very interesting. So maybe to follow up on that, and maybe Karan, you can come in here as well, given your expertise in this area. So if you move to kind of the regulatory landscape, then, and you mentioned, of course, the crypto side. So what are the biggest regulatory challenges that banks face?
Well, one of the challenges has been in the past, the regulatory questions for the board have been focused on, are we meeting minimum capital requirements? Are we meeting liquidity requirements? But we're seeing in recent bank crises like the SVB bank and Credit Suisse, that these banks basically were complying with the rules that were in place at the time. And what was lacking was an absence of a broader systemic strategy for the bank. And so the bank's business problems really arose not from failing to comply with the regulations, but from unseen, unperceived conduct problems linked to strategy. And so that's something that I would like to pick up on. I would ask our panelists if they, of course, the regulation is important, but it's not just what the regulatory rules require. It's sort of the principles that are inspired in bank governance that regulators are looking for. How do you feel you're fulfilling a more principle-based strategy?
So I can get started in here because I think there is a concept, at least in the United States, which is regulatory expectations. And that changes from time to time, depending on the regulator that you're speaking to or the specific regulation that you're talking about. That concept of regulatory expectation may change. And I think that makes it very difficult for banks to sometimes comply with certain regulations, because again, if you go by the letter of the regulation says something, but then you face an examination process, for example, and an examiner has a different interpretation of what the regulatory expectation is. So that's a kind of some challenges that I think banks in the space that I operate face on a day-to-day basis.
Julia, let me bring you in, given your unique position on fintech and on the bank board, because one question this raises is, for banks, how do you kind of balance the staying competitive, right, and complying with the regulations that some competitors don't have to comply with because fintechs might not follow the regulatory rules?
I see the point. So the thing with compliance is, I mean, it's the noun that comes from the verb comply, right? By the time you're complying, there's no competitive advantage anymore. It simply means everyone has to play by those same rules, right? So there's nothing to be gained there. The real value is in that other part which you talked about, the competitive advantage. Now, how do you gain that competitive advantage? Well, it's by, in my view, taking a broader look, and this is certainly something I did when I was in a fintech environment, is really taking a broader view of exactly what is the regulatory expectation, right? What exactly is it that the regulator is looking for? You know, if we take a very academic and very narrow definition of compliance, it's just going to be ticking the box. And that's what we find ourselves doing, ticking the box and just doing the mandatory disclosure requirements. But if you take a broader view of it, you might find that there are regulatory rules that actually offer you a better competitive advantage than the other players in the game. If you're a bank versus a fintech, if you're a fintech versus a bank, and I can certainly say that we've looked at some of those rules as a fintech, and we found that there were some opportunities that we could take using the same rules and be able to position ourselves much better than a bank could. So that's where I think that a bank definitely can find ways of having competitive advantage versus other players in the market. Yeah.
Thank you.
Yeah.
And
I'd like to just add kind of a side issue on this topic. I was reading just in the Wall Street Journal a few days ago about about companies, financial service companies, now beginning to embrace artificial intelligence, large language models, to help them gain that competitive advantage that Juliet has described. And I was wondering, is that something that at the board level that you see your colleagues talking about? Or it's a new area, of course, but it's been very much in the headlines, of course, with the big conference in Paris in January. And I was just thinking about how AI can be used as a tool to help bank competitive advantage.
So if you
I can. Oh, sorry. Yeah, I was going to expatiate on what I said. Sorry, Isaiah. Yeah. So yes, definitely AI comes with a great opportunity. It's also a responsibility, because now you see a lot of banks bringing in AI ethics skills into the C-suite, is because there are also challenges with adopting AI. But straight out of, in terms of the question, definitely AI is a great way in which banks can develop new opportunities and develop new products, new services, enhance existing ones. Banks are already adopting it in terms of fraud prevention, for example. Some banks are adopting it from credit scoring, from a loan provision, loan approval perspective. So there are many ways in which banks can adopt AI and create a real competitive advantage. The risk, however, like I mentioned, is there is, of course, you have to do a risk tiering, because a certain AI-driven decision-making are high risk. For example, what are the reasons on which the loan was approved? Are there certain biases that are inherent there? So banks have to also incorporate what you call explainability into how they adopt AI, so that you can look at the trajectory of that decision that was driven by AI, and you can really explain it, which is something that's very difficult when you are adopting large language models. So yes, it is definitely a driver of competitive advantage. Yeah.
Can I just quickly build on that? Yeah, I was going to say, by their very nature, banks traditionally have been perceived to be risk averse, and to try and get innovation into a bank and to incorporate AI and other new technologies that would really help the operations of the bank. What I have seen banks do is to create a sandbox where they can test new technologies and before they're incorporated into the bank. Trying to stimulate innovation within the banks generally tend to be very, very risk averse. It's better to inject that virus of innovation from outside the bank after you've incubated it outside, rather than try and stimulate it within the bank and then spread it from within bank infrastructure. And that's what I've seen banks, especially in this area of the world. I'm based in Nairobi. A lot of the banks partner with fintechs and tech companies that can assist with bringing in new technology into the banking operations.
Very interesting. There's 2 points that you mentioned, Juliet and Imtiaz, that I want to drill a little bit deeper into. So one is, of course, the question around, yes, AI will bring many benefits, but there's risks involved, right? And we need to think about those risks. You mentioned biases, right, and explainability. And Imtiaz, you mentioned that innovation. So one way is, of course, you're just adapting whatever everyone else is innovating, but how do we actually enable, as the bank board, how you enable the bank to innovate? And you mentioned it's much easier to do that outside of the bank than inside, and let's delve a little deeper into that as well. But let's take the first part, and maybe Sias, you can put your risk management hat on. In a way, so how do you how does the bank board oversee kind of the risks with, say, AI adoption? So we got kind of some kind of structures,
Yep.
mechanisms, because it's a tricky business.
Ideally, I would say you would want to have someone at the board level with the expertise in technology, because I think they would be in a much better position to oversee what is done in terms of AI. But unfortunately, that is a kind of a scarce type of resource, right? We know that. But there is an educational component that's also necessary when it comes to training communication of board members, to make them aware of those new technologies and how those new technologies can help or they can also harm. And having that understanding, I think that will equip them better to perform the duties of overseeing the implementation of those new technologies. I think I agree with everything that everyone said in here in terms of the biases, in terms of how difficult it is to innovate in a banking context. We are experimenting with some AI technologies here, but again, when it gets to the decision-making point, regulators are not comfortable that we allow the technology to make decisions. So we are using it in a very limited use case where you can summarize, you can prepare work, and can give you potential outcomes, but we are not there at the point where we'll be using AI for decision making. And then the last comment about the competitive advantage or disadvantage that compliance can pose to organizations, I think it can be a competitive disadvantage because the cost of compliance in the US is extremely high. The way fintechs operating here is kind of probably different than other countries where fintechs in the US, they need to have a bank in order to offer banking services. They don't have an independent license. They are not regulated independently. So it becomes, to some extent, for banks that want to compete against fintechs, it becomes highly unprofitable because you have the cost of compliance and some fintechs may not have the same. So it becomes very, very difficult. And perhaps with AI creating more efficiencies, especially when it comes to compliance, increasing productivity, maybe the cost of compliance will decrease and make some banks more competitive in the market.
And Kern, it has, just to pick up on what Isaiah said, with respect to the regulators, have the regulators increased scrutiny of AI adoption in banking? Is there any regulatory interest?
Well, there's consultations, discussion papers that have been issued by the PRA, the Prudential Regulation Authority, and in the UK, the Swiss regulator has a consultation out now as well with the banking industry. I think regulators are not really, and I think now with the current administration in the US, there is a goal of being more competitive in the AI space, and therefore not applying regulations in the financial sector so strictly as with respect to AI, at least in the near future. Even though they're going to still be KYC, know your customer issues, all the types of risks that relate to money laundering that the board should be worried about and have a committee for monitoring. But I think there is an enthusiasm, at least in the U.S., about the potential for AI to give the U.S. banking and financial service sector a competitive advantage. And I think that one of the risks that the EU runs now is the EU has adopted a regulation, the artificial intelligence regulation, that is very prescriptive, very rules-based. And many critics say it will constrain that innovation, that competitiveness that is necessary to develop in a new market, and that the UK and the US are not under this regime and therefore would have an advantage. Now, that doesn't mean that the risk with AI will go away because you don't regulate it very strictly. It means that they're going to still be out there. You might have the underlying risk of financial crime, of financial firms not really understanding the risk, that the AI may not assess the risk correctly. So those are things I think lie in the future. But I think at least the US and UK is better positioned to deal with the regulatory innovation aspects that come around AI.
Thank you. So obviously with the regulators trying to kind of keep up with the innovation, let me come back to then the second kind of aspect that Imtiaz mentioned about the innovation capacities and capabilities of banking versus fintech, in particular with AI, I think, and large language models that are very generic in general as they are developed. They're now being adopted to become more specialized in particular domain areas. So maybe Julia, is that do fintechs there have a better position in experimenting with LLM?
I think, okay, so fintechs have one advantage, and that's they have tons of data at their disposal. Okay. And a fintech would typically, of course, use that data. I mean, AI is at the back end of AI is it's all about data. So they have access to that data. But it doesn't mean that fintechs have exclusive monopoly on innovation. I think that banks, because banks have millions of consumer interactions or customer interactions, that's also an asset on its own. That is also an area with which a bank can also innovate. So it's different kinds of assets and different kinds of innovation. Where's the innovation coming from? For fintechs is a large access to data which they've gathered through multiple sources. The same thing for banks is in terms of customer interactions. I think where banks struggle a little bit is the fact that banks have a lot of legacy applications, and it's difficult to aggregate data from multiple legacy applications into one centralized data form that you can then leverage for innovation if you're going to use AI-driven type of innovation. I actually think there's a lot of potential in banks working closely with fintechs. I see fintechs largely, my fintech colleagues will hate me for this, but I see fintechs as part of the value chain of banks, right? And therefore, being part of the value chain of banks, the two entities, one has a customer interactions, one has access to data and potentially much more modern applications and systems that can then be used in training AI models and developing new products and services for consumers. I think that there's a good way in which both would work together. So you see, I'm trying to preserve my fintech credentials as well as not upset my bank, my board members on the bank side.
Very diplomatic. Imtiaz, do you agree? Do you see the same opportunity for banks and maybe even the same ability for banks to actually exploit the vast amounts of data that sits within the banks? That's essentially the competitive advantage compared to some of the fintechs, I would say, right? You have customer data. Or do you see I mean, there's regulatory hurdles, there might be cultural hurdles, other things. So you're optimistic or less so?
Very optimistic. And I'll tell you why. So banks, as you said, have a huge amount of data. But privacy concerns, regulatory boundaries, prevent them from making the most use of that data, and rightly so. I don't want my data out there with fintechs walking around. So I'll give you a practical example. I chair the asset management committee of Arise, which owns 8 banks across Africa, and we invest in banks. More recently, we decided to invest in fintechs, a couple of small startups, which have innovative ways of getting around the privacy concerns that regulators and banks have about the data that they have. So one of them is called Identify out of South Africa. What they do is anonymize the data that a bank holds, crunch through that data in an anonymized fashion, and are able to give feedback to the banks that they partner with on trends, on where the new demand is likely to come from, which sectors, which geographical areas that they could look at. And they do that by completely anonymizing the data so that it doesn't fall afoul of privacy concerns. It's very difficult for an investor like us who invest in banks, and you're looking at the PE multiple, and at the same time try and look at an investment in a fintech where Juliet will want me to look at 20 times revenue next year. And so tricky. But if you have diverse skills on the investment committee, then you can probably get around it. But in summary, very difficult to do it within the banking environment, as I said earlier. If you partner outside with fintechs, you can experiment in a sandbox.
Very nice. I hear from both Juliet and MTS, you're kind of in agreement with that partnership. Let's see, I think cooperation is obviously the way to go. Let me open up to questions from the audience, because we have already some coming in, so I don't want to let them wait for too long. And I'll pick up, so there's one in the chat, Leopoldo Martinez. Hi, Leopoldo, thanks for your question. Let me read that question. So I have a question related to the scope of the discussion. Uncertainty comes from outside and uncontrolled situations, and not from situations where management can decide if they want or not operate with. Or can we consider uncertainty in the perspective that fintech has different regulatory structure and is defined to create more positive competition? In my view, it's not uncertainty, is it? Okay, so I think, let me rephrase the question. So the question is around essentially that uncertainty that banks have to deal with come from kind of uncontrolled situations, right? So outside of the control of the bank. But on the other hand, if you think about fintech and fintech competition, the deal with different regulatory structure, that's not really uncertainty that the bank has to deal with. So bringing it back to kind of the topic of resilience of banking. So how should we then think about these different situations where, on the one hand, the bank is dealing with uncertainty, on the other hand, is dealing with essentially expected competition, like fintech. So are these different by nature in terms of how you would address essentially uncertainty in quotation marks that comes from fintech competition versus uncertainty, say, that is political? Would you deal with those different, or is it the same kind of structure, the same risk management systems that you would apply?
No, I think, put it this way, a bank and any institution, but a bank perhaps even more so, has to deal with risk from an integrated perspective. The challenge we have, and the reason why we're probably talking about this, is that traditionally we've looked at those as two separate risks, okay? There's a market risk, and then the first one, which is the uncertainty around political issues and political policies, or whatever comes in from the external political environment, is non-market, which we talked about earlier. Now, the real thing of where we're going is really, how do you integrate those two views? Because it's very important. You can't just focus on where's the next competition coming from. Is it fintechs is going to come from? Or is it going to be retail outlets that decide to offer banking services, which they did at some point, right? Or where is it going to come from? Where's the next competition going to come from? It's great, but that's very market focused exclusively. you've got to also look at the other aspects of it, the other side of it, which is which political environment do I operate in? What's happening there? What's the thought process? Is there a project 2025? And what are the elements of that project 2025? If it comes to be played out in its entirety, what does that bode for the bank, right? Are there other social activists and other pressure groups that could also pose risks for the bank? Because the reality is that it's not always every time that you solve a market-based problem with a market-based solution. Sometimes the solution lies in a non-market environment, just using a particular interest group to your advantage or using a particular regulatory rule to your advantage could actually solve some competitive problems in the market space. So integrating those two from a risk perspective is very critical. I think that's what this period that we're experiencing, that's what it's bringing to the fore.
Yeah,
Thank you.
So one quick thing that I wanted to mention is that not every bank is created equal. There are some banks that don't see fintechs as a competition, right? So the bank that I work for is a bank that enables fintech. So we don't establish direct customer banking relationships, but we do so via a fintech. So I think the partnership, the collaboration, and leveraging the expertise, as was mentioned here before, that fintechs can bring to the table, because banks are very rigid. Fintechs, they used to say, go fast and break things, because there is not a lot of regulatory constraints when it comes to innovation. So I think marrying those two together, I think it's a potential solution, because again, you can find different ways to mitigate risk.
Thank you. I'm going to pick up another question that brings us back to the graph at the beginning. Chris Moore is asking, back to the graph at the outset. So do you think the volatility seen now is different to that since pre-97 on the basis that the rules-based order of politics is changing? Think of tariff regimes or weakening of the IMF. And this could in time affect the power of regulatory regimes. So I think there's like two parts of the question. So is this kind of period of volatility or uncertainty, is this different than pre-97, which is where my graph started essentially? Or have you seen this before, essentially? Is there this period of uncertainty? And is this essentially, could this affect essentially the power of regulatory regime? So is essentially the system changing? Is there a system shift if you think about the US and the, I wouldn't say erosion, but the reduction of certain institutions, right? Regulatory institutions. That's an interesting question.
If I could just jump into that, Amir. Regulation goes in cycles, and you will see after a financial crisis, regulators clamp down, and you get stifling regulation coming in. And over time, the regulators and the policymakers recognize that we've overcorrected, and then you get a loosening of regulation. And you perhaps get another crisis, and you get a new cycle of new regulation. My view, we're on a cycle right now where we're looking to deregulate. Perhaps the regulation was too strict. So we're going to see some deregulation coming in, it seems. But I predict at some point, you're going to see tightening again. So it's a cycle.
Okay.
Yeah.
Karan, do you agree in that this is cyclical, or is it maybe even structural?
Well, I think it's a little bit of both. I would emphasize that in the 1990s we saw a period when globalization and liberalization of financial markets were being embraced, and we saw the emergence of Basel II in the late 1990s, and the initiative that was agreed by most countries in the world that we should have minimum capital, prudential, corporate governance standards for banks and other financial institutions. And there was sort of this kind of convergence of regulatory practices and standards. I've seen since these political crises have sparked a type of national response or even regional responses, which have departed or eroded this globalization approach. And what we're seeing are different approaches in the EU from the US, for example, now, or have begun to emerge. And I was going to ask our panelists in their respective jurisdictions, do you see this as a type of rise of regionalism, this kind of moving away from the globalization ethos that we had in the 1990s? Do you see that there are any opportunities for firms and banks in your markets with respect to this transition?
So I'll make a comment related to what I do for a living. And I think what I'm seeing now is, considering that we are in a period of potentially deregulation, some of the states in the United States are seizing a little bit of that responsibility. So over the last 4 years, we have seen a lot of enforcement actions related to BSA/AML, sanctions, and other areas, and banks get into regulatory problems as a result of weak controls. During the new administration, this is expected to be reduced, but then some states are getting together and using some leverage they have, and they are issuing their own enforcement actions, especially against some of the fintechs in the US. So that's something that we are noticing now. It's shifting from federal to state when it comes to the power to regulate certain institutions.
Yeah.
Karen, if I can build on your question from a very different perspective, and let me pick ESG and climate action. And I'll give you a practical example. So this week, one of the banks in my part of the world was grappling with whether they would fund a project to transport fuel on the Lake Victoria, rather than by road. The promoters of the project spoke to several potential financiers of the project. All of them said, fossil fuels, we ain't touching it. A bank looked at it and said, actually, if you transported fuel on the lake rather than by road, you would cut down emissions by 50% on the transport of the fuel. And let's face it, this part of the world where I'm based, we are going to rely on fossil fuels for some time to come. And so, yes, I'm not anti-climate action. I'm very green. But if you look at it from a granular perspective, you could probably justify, and rightly so, taking on a project like this with a timeline around what are you going to do to offset some of the emissions that are going to come through anyway, and can you afford it from an emissions perspective? Yeah.
I mean, Karen, to your question about whether banks are seeing, this whole regionalization or re-regionalization focus as an opportunity, a bank would if your time frame is short term. Okay. But if a bank remains one that says, look, my range of vision is long term, then they'll be doing things like the example that Isaiah has raised, which was, okay, so deregulation is saying and everything, nothing matters anymore. Let's just go, if it makes business sense, let's do it. But on your own, you're saying as a bank, hey, we know in reality that there are certain guardrails that should be there. And therefore, even if it's not enforced by regulation, we ourselves will put those guardrails because it is in our own long-term sustainable advantage. Okay, so that's the way I think, from my perspective, yes, this period will come and it will go. But from a long-term perspective, what is in the bank's long-term interest? Who are the stakeholders who the bank serves? That's the view that I think determines how a bank takes opportunities or identifies risks based on the current landscape that we're going through. Yeah.
Very interesting. Thank you, Juliet. Let me close before I hand over to Sarah with one last question to bring it kind of full circle to the topic of this panel, which is resilience. And Fuad Beg asked a question around. He really wants to understand the importance of experience, right, of the board or CEO, of the talent within the banks or fintechs, what the experience, what the importance of that experience for essentially managing risk and building resilience. So how important essentially are the background, the experiences of the CEO and the board in building resilience within the bank? In other words, what's the role of talent, of your human capital? Does it play a big factor, or is it essentially the structure, the systems, is it the IT, the risk management, the AI that is more important?
I think experience is important in any form, especially on banks. But let's give us a simple example. You'd like a pilot to be, piloting your plane that has thousands of hours of experience, or an individual that just got the pilot's license. We would always go for the first option. So I don't think that is different in a banking environment. So experience counts, experience matters, and experience is a contributor to creating resilience within an organization, creating strong frameworks that can be adaptable enough to deal with uncertainty.
Okay, thank you. Imtiaz, do you agree, or do you think that technology has leveled kind of or reduced the importance of experience?
Absolutely agree with Isaiah. And to pick his analogy around having a pilot, so banks have grown and become very complex organisms, and you could fly a Cessna as an individual pilot, but with the 787, you need a crew with diverse expertise, and I think this is what you need in bank boards. Is you need to cover a diverse range of key skills. Do an assessment of skills on the board and make sure that you're covering all the key aspects with experience on the board that you put in place.
Amer, I would add that in addition to, I totally agree with Isaiah and Imtiaz. I think the one thing I would add is to say, there's a big difference between knowledge and wisdom. Okay. So there is knowledge in AI, there's a knowledge in systems, there's knowledge, head knowledge, just from acquiring information and knowing how to use the information. But there is a certain element of what you call wisdom, and that becomes something that is closer to what resilience needs. Okay, because resilience relies, in my view, on applied wisdom, not just knowledge. You could be extremely knowledgeable, but being able to make certain calls at certain times that are not dependent on the calm-headed and very rational choices which need to be made at certain times, even when everything seems to be going awry. That's wisdom. Okay, and I think we still need that, and that is still something that is patently human, in my view. Okay.
Thank you, Juliet. Fantastic close, because that gets me to Sarah, who will tell you how the bank governance program hopefully will enable you to not only get the knowledge but also the wisdom to lead banks. Sarah, over to you.
Thank you, Amir. Hello from Oxford. My name is Sarah, and I'm the Senior Program Consultant for the Executive Education Finance Portfolio. I'd like to take this opportunity to introduce my colleague, Clara, who has been in the chat supplying links and information today. Together, we recruit and support all candidates throughout the application process. So if you've enjoyed the discussion today and are feeling excited by the prospect of spending more time with Amir and Kern, and a cohort of highly experienced individuals and executives, much like yourselves and our panelists today. And the upcoming iteration of Bank Governance Program is running this June from the 16th to the 20th in Oxford. And you should really put your applications in soon because those places are filling up really quickly. Please do email us or make an appointment for a one-to-one chat, and Clara's put that information so you could book those nice and easily. Do remember, if you have more than one colleague in your organization, we do offer corporate discounts for 3 or more attendees from the same organization. I do hope you enjoyed today's webinar and you look forward to getting in touch so we can organize your next steps of your Oxford Bank Governance Program for your journey to Saïd Business School. Thank you for your time today, and back to you, Amir.
Thank you, Sarah. Just leaves Kern and I to just thank our panelists. Juliet, Isaias, and Tias, thank you very much for joining us from different parts of the world and sharing your wisdom with us, and essentially taking time out of this uncertainty and uncertain times. And I'm sure you have your hands full dealing with it, to just share how banks can deal with this and share some of your experience. So great to have you again. And thanks again for all the questions from the audience. Hope this was insightful and interesting, and hope to see some of you soon enough in June. And of course, Imtiaz, Isaias, and Juliet, always welcome back to Oxford if you want to join
Yes.
again.
Yeah, thank you, MTS, Juliet, and Isaias. Really excellent to see you again, and we look forward to continuing our dialogue, and please stay in touch.
Thanks, everyone.
Thank you. Thanks.
Thank you.
Bye, everyone.
Pleasure.
Bye-bye.
Bye-bye.